My earliest entrepreneurial memory is my mum had a beauty salon. So, and my first memory was I must have been about 7 years old, and I'd cut all the flowers down in the garden, which my parents weren't too happy about, put them in jam jars, and I was selling them to the ladies that were coming to my mum's salon. But my first real business was actually when I was about 14. So I'd been buying bulk wholesale things, anything that came up as a disposal that was going cheap, I would buy and then sell them at car boot sales at the weekend. And when I was 14, I turned that into a proper business, and I had a market stall. I was selling, watches and jewelry and all sorts of stuff. And I left school at 15 to pursue that business. I was wholesaling items then to other market traders, went off on my kind of entrepreneurial dream from 15. So quite an early starter, and obviously missed out on the traditional education, which was a tough discussion with my parents because they were both the first in their families to get degrees. Both of them had gone through to the highest level of education. In fact, my mum was a teacher, and my dad had a master's in organic chemistry. Me deciding to leave school early was a little bit frowned upon, but they went to see the school career guidance counsellor, and he said that he'd never met a child before that actually knew what they wanted to do, so perhaps they should just let me do it. I mean, you learn the most when you fall flat on your face, and from a character perspective, it teaches you a bit of humility. When you first start in business, that's the day you think you know the most about business, and then every day is a new lesson, and some of those lessons come with some pretty painful school fees. You have to get through the mistakes and the things not working as you would expect. And business isn't logical. When you look at it on a blank sheet of paper, it should be easy and everything seems to make sense. And then when you actually try and execute a plan, it never really works the way that you expected. And so that's the kind of the rite of passage that you have to go through as an entrepreneur, is experiencing that full range of pain that you have to go through to get something off the ground. How to deal with staff, how to deal with customers, creating a product, marketing, and marketing is just a constantly evolving thing. The next step for me after spending decades or a couple of decades doing that was then to move into the kind of next rung of the entrepreneurial ladder, and how you buy a company and how you sell a company. So moving, I guess, from customer value into shareholder value. In 1997, I had a telecoms company. Telecoms is very acquisitive, so people are always trying to buy you. So my earliest education in M&A was being pitched by these companies that were trying to acquire my business. Interestingly, the kind of thing they all had in common was that they weren't going to give me any money. So I pivoted that to the idea that, well, I don't have any money, I'll go and buy a business myself, so I'll be the buyer instead of the seller. And so I went looking for other telecoms companies I could buy. I did my first deal. It was a huge epiphany. We grew by a year's worth of sales in an afternoon, and we hadn't had to invest any money in marketing. It was a no money down transaction. We didn't have to borrow money from the bank. It was a distressed deal that I bought for $1, basically. And I suddenly realized that you don't have to run the marathon. You could just run the last 10 yards and you still get a medal. After a number of years of growing that business, and we grew quite rapidly through acquisition, after that I decided that I would sell the business. And when I sold the business in 2006 and was kind of thinking, what do I do next? I realized that the bit I really enjoyed was the deal. It was the buying and the selling of businesses, not necessarily the staff and the customers part. In fact, I often joke to people that business would be great if it wasn't for staff and customers. Try not to say that in front of my staff and my customers. So I then decided just to buy and sell companies, and I decided to de-risk that activity. They call it asymmetric risk in the hedge fund world, which is don't put any money in and then you only leave room for upside. So basically I did a lot of distressed and motivated transactions where I would effectively buy all of the equity for $1, restructure the balance sheet, or do some kind of turnaround dressing up of the business, and then sell it on again quite quickly. And I did that for a number of years. I probably did about 50 transactions like that on the buy and sell side over a 10-year period. But while I was doing that, I noticed this huge gap in, I call it the mid-market, but I think in financial circles they probably call it like the nano micro market, because these are companies that are profitable, debt-free, well-run, typically $1 million to $5 million of EBIT. And what I noticed was that they're incredibly underserved. So the banking industry doesn't like to fund those kind of businesses unless the owner's willing to bet their house. So everything is tied up with lots of personal guarantees. Private equity and VC aren't interested because they're too small or they're not in a particularly sexy industry. And yet these are a huge part of the economy. In fact, small businesses generally are a massive part of the economy. If you look at every mature market, 50% of GDP comes from small businesses, and they're a huge percentage of the private sector workforce as well. And yet they're basically left to rot. And actually, if you look at asset management companies who kind of pride themselves on their diversification, and you look at the asset classes they are invested in, they're invested in everything. They've even got a crypto allocation now, and gold and silver and equities and debt and all of these things, and yet they're not invested in small business. Basically, I looked at that and I thought, well, why is that? Why is, money is smart, money likes to be diversified. Why is it ignoring half of the economy? And it really comes down to three key reasons. And the first one is small businesses are still too risky. You lose a couple of key staff members or you lose a couple of customers, you have a terrible year. They suffer from their scale. So scale from an investor standpoint, you can't put enough money into them. So if you're a fund or a family office, small businesses just can't take $10 million or $5 million that you want to invest. It would be more than the whole business is worth sometimes. And then also just scale in terms of the business's approach to the world. You kind of have to be big to get big. You can't win big contracts until you're already big. And this creates a bit of a glass ceiling for these businesses that they can't break through. They can't grow beyond a certain size. And then the final one is liquidity. Small businesses are horribly illiquid, so when you invest your money in them, it can take a decade before you get your money out. And smart money nowadays wants that liquidity to be able to jump in and out of different investments. So basically when investors look for risk, scale and liquidity, they find derivatives, bonds and stocks a much more easy thing to invest in, and therefore that area of the market has ballooned, particularly with quantitative easing, and the small business sector is still completely devoid of capital. So I decided if I could solve the problems of risk, scale and liquidity in the small business world, we could effectively unlock global capital and get it into small businesses. And I think that would have, you'd create small business as an investable asset class. And if you could do that, then you would have the potential to democratize wealth, because effectively those asset managers would want to be diversified and would want to have exposure to such a huge part of the economy. Traditionally, private equity, when it wanted to solve those problems of risk, scale and liquidity, would do a roll-up. And they would put loads of businesses together. But in my own experience of dealing with owner-managed small businesses, I know that there is a kind of culture that's been created within those companies. It's a culture with their staff and with their customers that you can't just jam together and end up with more than you started with. So we created our own governance structure, and we call it agglomeration. An agglomeration is a trademarked structure that we've developed. And effectively it allows small businesses to collectively own and control a fully reporting public company. So it's a way for small businesses to effectively collaboratively IPO. So they can get together as a portfolio of businesses and access the capital markets. And that solves the problem of risk, because it's now a diversified portfolio of small businesses, so diversified across countries and currencies and products and services. It has the scale issue resolved, because it now has a huge profit and loss and balance sheet that they can point to. And it solves liquidity, because people can invest and divest from the business very easily. One of the challenges when you run a small private company is the illiquidity of your own shares. So typically what happens with a small business is that when you sell a company, it's kind of a binary decision. You sell or you don't sell. And there's never a right time to sell, or it's very hard to pick the moment to sell. In fact, most people get it disastrously wrong. And the kind of run up to sell can be 2 to 3 years. So from deciding you want to sell to actually selling can be quite a long time horizon. And an awful lot can change in that time, both politically, macroeconomically, in your industry. Google could start doing it for free and decimate your business. There's so many headwinds or black swan events that can potentially interfere with the exit of a business. And in fact, most people don't have that luxury of choosing the 3-year run-up. There's some health issue or some other issue that forces them to have to take some action sooner. And then the decision is out of your hands, and the ability to get the maximum value for the business is out of your hands. If you've already gone public and your shares are now freely trading public stock, it takes away that binary nature on the exit. You could exit the operations of the business but still be a shareholder. You could exit the shareholding but still be operationally involved. So it gives you a lot more options as a business founder. We've got a really big vision now that we've got the bit between our teeth when it comes to agglomeration and this idea of democratizing wealth. We see, we believe there is now a decade or more of what's been described by many pundits as the largest transfer of wealth in history, which is tens of thousands of baby boomers retiring on a daily basis. It's 10,000 a day just in the US, people retiring. In every major economy now, adult diapers outsell baby diapers. So in Australia, New Zealand, Japan, UK, US, Canada, there are more adult diapers, nappies now sold than children's ones, which is a pretty scary statistic. But small to medium-sized businesses are by and large owned by those baby boomers, and they are looking to succession plan. And they have slightly different motivations than previous generations have had, because they're not going to get great multiples for their businesses like you could before, because there is an oversupply of businesses. In fact, for every 100,000 businesses advertised, only 20,000 are not advertised the following year. So not all of those have sold. Some of those are just given up. So there's not a lot of those businesses closing, and the multiples of small businesses have been getting squeezed down and down and down and down, to the point where more and more people are choosing to wind the business down and then just close the doors to suck as much cash out of it as possible over a period of time, than to actually seek a sale. And also, most of the time, they hate their big competitor, so they won't sell out. It's like do or die. They won't sell to the competitor. The next generation aren't interested. They want a blockchain marijuana app. They want something that's trendy. They don't want an air conditioning company or a lift installation business. So all of these really great businesses that are generating good profits need to be transferred to someone. What I'm looking for is the pinnacle of that pyramid, the businesses that are generating 7 figures plus of annual profits, that we can take into that public environment and create an awful lot of shareholder value. Yeah, like I say, democratize wealth would be the big vision. So I really see myself in the next 5 to 10 years being pretty much on, as I am now, a non-stop roadshow of meeting with these business owners, pitching these business owners, dealing with investors, taking companies public, and executing on this vision that we have. I think I've been quite lucky with lucky's an odd word, but with the weird path that I've taken in my life as an entrepreneur, it has kind of culminated in a moment where I now have 20 years of experience buying and selling small to medium-sized companies. I've taught hundreds of people how to do it. I've worked on joint ventures with hundreds of people who I've taught how to buy small businesses. So there's not many people in the world that have that level of experience in that very specific niche or area, and it happens to be a huge part of the economy. And now we're arriving at a time where that skill seems to be very, very necessary.